Hi everyone, good morning. Welcome back to the channel. So now we are going to start with cash flow analysis ratios. Previously we have discussed about free cash flow, and now we are going to start with cash flow analysis ratios. Uh, so cash flow ratios use cash-based numbers, not accounting profits, to measure a firm's liquidity, efficiency, and financial strength. Unlike profit-based ratios, these ratios focus on real cash, which makes them more reliable for assessing a company's ability to survive and meet obligations. So let's start with operating cash flow ratios. Uh, so the operating cash flow ratios measure short-term liquidity, and it shows whether a company can meet its current liabilities using cash generated from operations rather than relying on borrowing or selling assets. The formula for operating cash flow ratio is operating cash flow. We divide them by current assets, current liabilities. If the ratio is greater than one, it means the company can pay its short-term debts from its operating activities. And if the ratio is less than one, it means that the company depends on loan, asset sales, or external financing to meet short-term obligations. So operating cash flow, we divide it by current liabilities. So if this ratio is greater than 1, this means operating cash flow portion is going to be bigger than current liabilities portion. And if the ratio is less than 1, this means the current liabilities portion is bigger than the operating cash flow portion. And that's why it means that the company is dependent on loans, asset sales, and external financing. And this is what current liabilities means. uh, Loans, short term loans basically, and financing. And this ratio is better than the current ratio because it uses actual cash flows, not inventory or receivables that may not convert into cash immediately. The current liabilities, operating cash flow. So we need, so this is important. This is an important ratio, operating cash flow ratio, because operating cash flow it's actually kind of an indicator that we, whether or not we are cash positive or not. Operating cash flow, we are able to generate positive cash flows from operations, and if we are not able to generate positive cash flows, this means that the company relies on borrowing or asset sales basically. That's the basic understanding. Less than 1 or greater than 1, this is what it indicates actually. Now let's talk about cash flow margins. The cash flow margins actually measures the efficiency of converting sales into cash. So it measures efficiency of turning sales into cash. This ratio answers the question, how much cash does the business generate from each unit of sale? Um, so higher margin indicates a stronger cash generating business, and lower margin suggests poor cash collection or high operating cost. This ratio is commonly used to compare companies within the same industry because it shows how efficiently different firms turn revenue into cash. So, in the notes section, also, I have mentioned that commonly used to compare companies in the same industry. The third ratio, the cash flow analysis ratio, is free cash flow, which we have discussed previously also. Free cash flow represents the cash available after maintaining the business, and capital expenditure represents the maintenance cost of the business. The formula is free cash flow is equals to operating cash flow. We subtract the capital expenditure, and capital expenditure includes spending on machinery, equipment, buildings, or technology required to keep the business running. Free cash flow can be used to pay dividends, to reduce debt payments, to reduce debt basically by repaying it. By free cash flow can be used to expand operations. So investors heavily rely on free cash flow because it reflects the company's financial flexibility and the long-term strength. And it's very obvious, if you do not have a flow of cash, how will you repay your? I mean, how will you repay your debt? How will you pay your investors? How will you expand operations? So for that, you actually need to have positive cash flow, free cash flow, basically after your expenses, after your this is actually the cash available after maintaining the business. The definition is cash flow available after maintaining the business. Okay, so now let's talk about the free cash flow coverage ratio, which is the last ratio of cash flow analysis ratios. Okay, so cash flow coverage ratio. So cash flow coverage ratio measures the ability of the company to service its debt. This means that, okay, the formula here is that the cash flow coverage is equals to operating cash flow upon total debt. A higher ratio means the company is safer for lenders, and a lower ratio indicates difficulty in meeting debt obligations. And this ratio is especially important for banks and credit rating agencies, that it helps them to assess the risk of the default. So the ratio here is operating cash flow upon total debt. Now understand this ratio and see, operating cash flow, we are dividing it by total debt. This basically means that if our operating cash flow is 100 and this is our this 100 millions and $10 million was our to debt, this means how much per dollar of debt we are able to generate in our operating cash flows. So this is actually a indicator of efficiency, business efficiency. Also, it's showing how efficient the business is being run, how better we are using, how efficiently we are using our debt. So per if we try if we solve it, for every $1 of debt, every $1 of debt, we are generating $10 of operating cash flow. So since we are talking about finance, we need to think it from the perspective of finance. I hope you are able to connect the dots here. And every ratio which we have discussed about, try to analyze that ratio in this form. For every $1 of sales, how much operating cash flow we are generating? For every $1 of current assets, how much operating cash flow we are generating? So try to think from a perspective of finance. All right. So we will be able to grasp the ratios, the concept of ratios better when we will start applying those concepts in the forecasting, and when we'll talk about forecasting and when we will talk about majorly forecasting. Before that, when we will be discussing the income statements, oh, sorry, the financial statements, then we will talk about them, the ratios. We will understand the ratios, but we will apply them when we will be doing a proper valuation and when we will be discussing about forecasting. the health checkup of companies. Then we'll be talking about the ratios in detail. So let's talk about the cash flow forecasting ratios now. Okay. So cash flow forecasting predicts future cash flows, inflows and outflows both. So future cash inflows and outflows. Its main purpose is to prevent cash shortages and uh, plan growth effectively. So here, when we talk about why does it matters and why it's important, understand this thing that cash flow forecasting is important because it prevents liquidity crisis by identifying shortages in advance. So liquidity means when we are in the need of cash and we do not have that cash. So that will be the liquidity crisis. So it actually prevents the liquidity crisis. It helps schedule investments at the right time. Uh, it actually supports loans and investor discussion by showing financial planning. So, and without forecasting, and even profitable businesses can face sudden cash problems. So that's why we need uh, to forecast the future cash inflows and outflows so that plan effectively our we can plan our growth effectively and we can prevent any cash shortages in future. So type of cash flow forecasts. The first type of forecast is short-term forecast, which is daily, weekly, and monthly, which can be daily, weekly, or monthly. It's used for payroll planning, rent and suppliers payment, managing seasonal fluctuations. They actually help managers ensure that day-to-day operations continue smoothly. And the second type of cash flow forecasting is long-term forecasting, which is quarterly or annually, and it's used for expansion planning, capital budgeting, and strategic decision making. And these forecasts support long term growth and investment decisions. Basically, uh, so the basic forecasting steps include. Uh, these are the basic forecasting steps. Let's discuss them one by one. So first, what we do is we estimate the cash inflow, such as sales, collections, and loans. And then we estimate the cash outflow, such as expenses, debt payments, and capital expenditures. This will help us calculate our net cash flows. And we have discussed about net cash flows previously also. So from inflows we subtract outflows, and that gives us net cash flows. After that, we track opening and closing cash balances of from the balance sheet. This is a part of balance sheet, uh, which is also a part of cash flow statements. And we update forecast regularly using a rolling forecast approach. The rule here is that we always forecast cash conservatively, not optimistically, because over optimism leads to cash shortages. So that's the rule we are going to use. Conservative approach, not optimistic approach. We cannot be over optimistic about our cash because that could lead to cash shortages. So remember this rule. This is important, and this will be used when we will be working on our financial statements, forecasting, and then we will be working about valuation. So these rules you need to keep in mind. Okay. Now let's talk about cash flow problems and solutions. So common cash flow problems are late customer payments. This problem occurs when sales were made, but cash was not received on time. And it's very common in B2B business, business to business, where the businesses deal with businesses. So this is a common problem. The solution here is to shorten payment terms, offer early payment discount, or enforce credit checks. These steps improve cash collection efficiency, and these solutions can be used. The another problem uh, comes the cash flow problems is high fixed costs. So high fixed costs such as rent, salaries, and leases drain cash during slow periods, and businesses actually run in cycle. So the solution here is to convert fixed cost into variable cost and renegotiate contracts, and along with that, outsource known core activities. And that is why you will see that most of the companies actually outsource their operations because it actually helps them with the fixed high costs. So they actually outsource their known core activities, documentation, the process which is not adding any value. So they actually outsource those non core activities. And rapid growth also is a problem when it comes to cash flow. So rapid growth often causes cash problems because growth consumes cash before revenue arrives. And the solution here is to secure working capital financing, improve inventory turnover, and phase expansion gradually. So this means that growth must be planned, not rushed. And rapid growth actually is a problem for it actually causes cash problem in businesses. Another problem when it comes to cash is poor inventory manage. So poor inventory management. So poor inventory management leads to too much stock. Cash is locked up in inventory. So the solution here is just-in-time inventory. It's a Japanese concept. Just-in-time inventory, better demand forecasting, and better slow-moving products. Discount slow-moving products. This actually releases the blocked cash. This actually helps in releasing the blocked cash. Okay, last but not the least, the debt pressure also is a problem when it comes to cash flow. So debt pressure occurs when loan repayments exceed operating cash flow. And that's why businesses actually refinance their debt, they extend loan terms, and they improve operating cash generations. And managing debt is actually critical for financial stability also. And you cannot always put all your cash uh, into repaying the debt. You actually need to use your cash flows very intelligently. Oh, all right then. Let's discuss about cash flow. Uh, Startups versus large company. Then this is an example. This is going to be uh, this is going to be a small case study which I have prepared. So when we talk about startups, the characteristics of startup is that they often have negative cash flows. The uncertainty is high. This means the risk is high. Risk is high. Depends on external funding, yes. Borrowed funds. This means highly financed. Focus on growth over profitability. So they are not focused on profitability, but they are more focused on growth. And the key metrics when it comes to assessing of a startup is burn rate, which is the cash spent per month, and the runaway, which is months before cash runs out. So how many months of cash do we have? and how much cash we are burning or spending per month. So survival depends on cash runaway, not profit. And for startups, yes, this is true. But when we talk about large companies, now understand this thing. Startups work the when we are assessing the startups, we need to look at different metrics. But when we are looking at the large companies which are stable in nature, we need to look at different metrics. Uh, so the psychology of running a startup and the psychology of running a large company is different, way too different. So when we talk about large companies, the characteristics are that they are stable and predictable cash flows are there. Positive operating cash flow is going to be there, yes, because they have established a business model and they have been in the market for a long time now. And since they are in the market from a long very long time, they are dominating, and that's why they have become a large company. Easier access to credit, yes, they actually have a easier access to credit because they actually have a history. They actually have a history of good cash flow. They focus on optimization and shareholders return. And the key priorities when it comes to cash, a large company is free cash flow generation, dividend stability, and debt servicing. So let's do a side by side comparison of a startup and a large company. Now, cash flow, when we talk about the cash flow, startups actually have a negative cash flow often, more often. Startups frequently have negative cash flow, especially in early years, because they actually have high spending on product development, marketing, and hiring. Uh, they limit or delay their revenues. They focus on building customers and market presence first. And negative cash flow does not mean the startup is a failure. It often reflects investment in growth. When we talk since and in the same way, if we talk about large companies, so large companies usually generate positive cash flow because they have established customer base, they have stable and recurring revenue, and they actually have efficient operations. Positive cash flow allows large firms to pay expenses, invest and reward shareholders without constant external funding. When we talk about the predictability, so startups actually have a low predictability means or highly unpredictable means they actually have high risk. The reason here is that uncertain customer demands, changing business models, dependency on new product acceptance. And this unpredictability makes cash planning difficult and increases financial risk. However, when we talk about the large companies, the predictability of large companies is it's predictable actually because they actually have a long operating history, diversified products and markets, stable contracts, and repeated customers. And predictable cash flow enables accurate forecasting and long-term planning. I hope this was clear. When we talk about the funding sources of startups as compared to large companies, for startups, the funding depends on external funding. I mean, the startups depend heavily on external funding, such as angel investors, venture capital, and founders' capital. And since internal cash generation is limited, startups rely on investors to finance operations and growth. When we talk about large companies, so large companies actually use a mix of operations and debt. They've actually fund themselves through cash generation from operations and through debt financing, which is bank loans or bonds by issuing bonds in the market. Their strong cash flow allows them to borrow at lower cost and rely less on equity dilution. Okay, so Risk. When we talk about risk from of a startup as compared to a large company, so the startup actually has high risk because startups face high risk and business risk, high business and financial risk. And the reasons are quite obvious because they actually have limited operating history, high cash burn, and uncertain revenue streams also. A cash shortage can quickly lead to business failures. So if a startup uh, encounters a cash shortage, it can quickly lead to a business failure for a startup. But on the other hand, when we talk about a large company, they actually do face moderate risk because they have strong cash reserves. Yes, cash reserves. They actually have cash reserves, diversified revenue, and easier access to easier access to financing. And during downturns, or during bad times, they usually have buffers to absorb shocks. And from a perspective of focus aspect, here we are talking about the focus aspect. Startups focus on growth and survival. Uh, Surviving in the early stages, achieving rapid growth, capturing market shares, profitability is often secondary to survival and expansion. But large companies focus on efficiency and returns. So, operational efficiency, maximizing returns and shareholders' value. So, large companies, their goal is to optimize performance, not just survive. So, they believe in optimizing performance efficiency. The overall interpretation of this table is that startups manage uncertainty and survival. Large companies manage stability and optimization, and both require strong cash flow management, but priorities and strategies are very different. And if I actually had to uh, summarize this thing in one line, so startups burn cash to grow, while large companies generate cash to optimize and reward stakeholders. I hope this much was clear. In today's session, we have discussed about, majorly everything which is related to free cash flow. Free cash flow. We have discussed about the ratios also. Everything which is important, and this is going to be the foundation for free cash flow to the equity and free cash flow to the firm discussions, which we are going to discuss in the next episodes, next lectures. And the final summary here is that cash flow ratios reveal financial strengths better than profits. Forecasting prevents surprises and support planning, and cash flow problems are common but manageable with discipline. And startups manage survival, large firms manage optimization. Okay, so that will be all for today. If you have any doubts still, then you can always post your questions, your doubts in the comment section. Thank you for attending the lecture. My name is Deepak Bisht, and I will see you in the next episode. Thank you, everyone.